yeah, as Sam said, my name is Brendan Oleski. I'm going to introduce my panel here. First, we have Evan Krapko, founder and chairman and CEO of Trust Science. Evan is a serial entrepreneur and investor, having numerous startups, and he is a Henry Crown Fellow and member of YPO and has been named to the Real Leaders Global 100. Up here. Next, we have David Knightley, Chief Revenue Officer at True Decision. David has more than 25 years experience in consumer lending space. He was most recently COO, Vehicle Solutions Corp. He also had roles at Onyx Capital One, GM Financial, and Exeter. Finally, we have Matt Rowe, the Chief Revenue Officer at Open Lending. Matt oversees all aspects of the customer partnership model by providing high-quality consultation, training, and deployment strategies for their lenders protection products. All right, so we're going to get started with a very basic question. So when we hear the word alternative data, what is the difference? What is alternative data? What is the difference between alternative data and traditional data? Dave, you want to take this first?
Yeah, sure. I think we build a lot of models for lenders across the U.S. and Canada. And when I think of traditional data, I think of stuff you get from the credit bureau, application, consumer data that you can derive through dealer tracking, things like that, versus non-traditional means. Some examples of that is when we're back at Exeter, we used an outside vendor with payday loan data called Factor Trust. Microbill, there's many others. Big trend today is on the, someone mentioned it earlier, on bank account level data that's outside the credit bureau that can enhance your models. We'll do some things to do there. But that's the way I think of it.
Add to that?
Yeah, I would say the same with the caveat or the clarification that in Canada we have characterized it as a bit of a desert for data compared to the US. So some of David's examples are not available here or don't exist. And then there are other vectors that come in from the consumers themselves. So sometimes if you're talking to conventional data providers, that business of being directly in touch with the consumer as a consumer reporting agency is not standard, but there's more and more of that coming into the equation.
Matt?
Yeah, so for us, I mean, we started using alternative data in 2017, and a lot of that is, LexisNexis is a big provider of that, so non-traditional, as the guys pointed out, cell phone bill, utility bill, so the normal non-reported to the Bureau's credit data. And for what we do, specifically near prime focused auto lending, it's a great source for us to be able to augment the credit data that we're getting to give us just a better idea of how that consumer's ability to repay, just a better holistic picture. So, because traditionally they'll pay those utility bills and phone bills almost more so than some of the credit card payments first.
So we talk about alternative data. What are some risk factors in utilizing it? So it could be, whatever it may be. Could it overlook stuff? Could it miss things? What if as a lender, what risk factors should I be aware of?
Yeah, so for us, cleanliness of the data, data integrity is obviously a big risk factor and then for us in the U.S., compliance, regulatory scrutiny over what data you're using. Is it discriminatory? Are you using it in a way that is transparent to the consumer? So those for us are the biggest risk we see just with using that alternative data.
Yeah, related to the compliance piece, and then again in the U.S. where the consumer protection bar is way, way higher than it is here in Canada. Big penalties for scoring Joe Smith with the other Joe Smith's data, or risks in not being able to do identity management or entity resolution properly, so getting to a proper, what we call consortium style database. Having things in a platform makes it a lot more straightforward than what we see as a risk is if you're just grabbing alternative data from various different sources but not having it formed what we call cleansed or put into feature blocks, you're asking for trouble on reaching the wrong decisions.
Sure. I look at it from a little bit of a different lens, from the standpoint of when I look at the risks associated with it, it can be over-reliance or under-reliance. So back to the company I talked about, when we were at Exeter and Blackstone came in around 2011 with a big infusion of capital, we obviously had really bottomless pockets to buy whatever we wanted in the market, so we started to test that product. Theirs was around payday loan data, which we found it was robust. Of course, Factor Trust at the time was brand new to the U.S., but the point here was there was some lift off using their data. Now, of course, they wanted us to use it on every loan we booked. We didn't see the need to do that because once we tested it, we baked it down to, in certain pockets, it was very useful, but it really just became a plus or minus to the score. So if they had a negative event through a payday loan lender, that was a deduction to the score versus a positive. So it wasn't a replace all traditional methods, but an augmentation, like Matt talked about earlier, where we were able to gain significant lift in forecasting the rate of default based on the outcome of that equation.
So, Matt, you brought up something about discriminatory scoring and things like that. So, how do you kind of segregate that data to make sure, to protect it so that you're not being viewed as, different data? So,
Yeah, but, we've got a whole team, just regulatory audits, what is the data that we're using, ensuring, and again, in the U.S., we're I think, more regulated on what data we're using. I mean, the four-letter word, the CFPB, is actively looking for someone to make an example of, and so you just have to be really cautious about the data set, and then as you start to incorporate AI and machine learning, that those models are not inadvertently using some of that predictive data. So just constant eyes on the model and doing audit trails to ensure that there is no fair lending or compliance issue that you inadvertently created by using this data set.
Something that's not necessarily intuitive, probably everybody in the room understands. You can go about your work without incorporating prohibited factors, but end up being discriminatory, constructively discriminatory. So there's the outcomes that the CFPB in the U.S. also looks at. So we've voluntarily, it's not required anywhere in the FCRA or ECOA, but we voluntarily submit ourselves to those kinds of compliance audits. I think that in Canada, there isn't the equivalent of the CFPB, but a lot of people take the position of running away from the regulators. We've taken the opposite position. We're working with them, being proactive, conducting workshops or submitting white papers. It's their mandate to protect the consumer. If you're showing how you're doing that and finding those invisible primes, or what we call the invisible primes or the hidden primes, and solving for structural exclusion of prime and super prime people, just because they have a conventional score assessed conventionally, they have a low score. If you're showing the regulator that we're helping consumers, and our customers are not charities, they're lenders that need to stay in business. So there's a win-win there that to us seems pretty obvious and easy to attain. But in Silicon Valley, they have the mantra of go fast and break things. When you're in a highly regulated industry, you go fast, break things, and go straight to the stockades. So that's not a good business model.
That's right. Yeah, so from the consumer standpoint, I mean, when you look at it from a modeling perspective, when you're either trying to enhance models, what are you trying to do for a lender rate? Part of it's forecasting, but it's take more bads and move them down and push more goods to the top of the model, right? So that's where you can find pockets of paper that may perform like prime, like he's referencing, and then ones that may look differently, or like Daniel's presentation, kind of the under the hood or the DNA of the consumer might look exactly the same. It's a 550, it's a 650 FICO score. You can take any pockets, but some of those are going to behave like subprime. So when I think in terms of that, I tend to agree with him 100%, where you want to come alongside from a regulatory standpoint and be able to define and document what you're doing, then you're in good shape. If you're not doing that and you're just pulling different data sources in, but you're not able to elaborate what that does to the consumer, you're going to get in hot water pretty fast, in my opinion.
There was everyone's familiar with AI. Maybe you're not familiar with the fact that it started 50 years ago, 45 years ago. It's not economical to do. And lots of people in this room were all over that. But it's only 7 or 8 years old, 8 or 9 years old, explainable AIs. And so the rub on machine learning is that it's a black box. But to what both of my colleagues just mentioned, that explainability is critical. If you can't get to XAI, or you're not dealing internally or with vendors that are very, very, very familiar with that, then all the alternative data in the world is just going to be a recipe for a nightmare.
Yeah. So along the lines of AI, right? Do you, excuse me, the risks of using it, like, I mean, you all talked about how there can be discriminatory scoring based using alternative data. Do you see a concern with AI, machine learning, like kind of doing the opposite of it, where it looks at the data, learns how to discriminate based on different factors? Is that something you would see, or is that?
I look at it, I mean, I'm not an AI expert by any means. That would be more for my business partner. But from just take AI as an umbrella and go from a machine learning perspective. We have our own internally built attributes that we use to build models with. Okay, so if I'm going to take 1,012 attributes that I'm going to look at and try and funnel down to a number that's the most usable and predictive, the sun will burn out if I have someone doing that manually before that happens, right? So you're not going to deliver anything in any kind of time frame that you need to. So when I look at tools like that, and we use those internally, you heard my business partner talk about it earlier, where, okay, kind of the mantra out there from Google, Facebook, well, AI is a hammer and the whole world's a nail. Well, in auto, it's a little bit different. Credit's a moving target, it moves all over the place. You need to identify these differences between economic standards, what's shifting, inflation, and then weigh that against your traditional systems and models, and then is there enhancement? Can AI or machine learning help me find things within that I'm already using? They're totally fine from a compliance standpoint, but is there something we're missing to enhance those models internally? That's kind of the way we view the world from that perspective.
The beauty in the techniques or technology nowadays and the computing horsepower and so on that can be brought to bear is that these are learning systems to your question, and they can incorporate in a very elegant manner, very predictive manner, a lot of different data, conventionally, eventually all unconventional things end up becoming conventional in the course of time, but in getting through that journey, being able to retrain the models quickly, that used to be considered negative, because then you'd have to redo your strategies every time you're changing the model. But the big, huge power in that, and the ability to build your workflows automatically or in conjunction with scores and indices that are getting calculated, the big, huge advantage of the AI piece is that you can get that retraining. In the previous panel, you can actually now use this to spot the turns in the economic cycle. Let's say you might lag it by a month, but the alternative data combined with traditional data, we're not allergic to conventional data, but combining the two on a platform that's retraining quickly lets you catch where there is now different operating conditions. David's exactly right. Credit's a fluid platform, and so being able to see the turns both at the top or calling the bottom, or only being lagged by a month on each of those, that can make a lot of difference in a world that's accustomed to having status quo methods and technologies for quarters or years at a time. In a much more chaotic world, it's a really powerful thing to have a platform that you've built for yourself or that you've invoked from others that can do that.
Yeah, I mean, there's obviously risk, I think, with any new technology and deploying that in a highly regulated industry. But I personally, we see the reward outweighs the risk. I mean, when we started using alternative data in 2017, we, in the first couple of years after that, we, originated at probably about $8 billion in auto. What we found was, especially in the near prime population, is, if you're lending in that area, you're trying to make sure that you find the credit scores that are on the way back up, and then surcharging or adding rate to the loans that are going down. And we saw our alternative data and model augments 65% on average into another credit tier. So those 640s that we had good alternative data that showed a positive trend actually got augmented up into a higher credit tier. And what that allows us to do is be more competitive in the environment from a pricing standpoint. And then alternatively, the ones that we saw data that was negative, we were able to surcharge those. And so it helps us from an adverse selection standpoint, give us just a better view, and then be more competitive out there in the market from the modeling standpoint.
I would add one more thing to that on the AI piece. One thing we work very hard at internally when we're customizing a model for a bank, credit union, whatever, is overfitting, right? So you can get into looking at attributes and you may, I pulled this one thing out, this is very telling, if you will, and when you plug that in, that needs to be studied. I heard, I think it was the representative from Program yesterday talk about this extensively, where no matter what model you put in, whether it's traditional, non-AI, or otherwise, they need to be monitored, they need to be studied. Are we really getting left? You can see some of the bigs recently, Google, Facebook, others, they've pulled back on their AI. Why? Because it's not an unleashed stallion. You have to be able to corral it and make sure that it's doing what it's intended to do.
So one of the questions I have around alternative data. So Matt, you mentioned cell phone bills, different things like that. How do you avoid that being perceived as an invasion of privacy for the consumer?
Yeah, I think this transparency is key. That you're using the data. I mean, for us again in the States, for using that, we still have to be compliant with the FCRA and report that these types of sources were used in making our decision. But I think someone mentioned earlier, when you're using these different data sets, I mean, the point is for us is to be able to have a better view of the borrower's ability to repay. So in the end, we're trying to come up with a better score to allow us to extend credit to more consumers that would otherwise need it. So I think, again, just demonstrating how you're using the data in a transparent way, and then the purpose of why you're doing that is to allow for better credit risk, approval risk. And so I think keeping those two things at the forefront of why you're doing it is going to help.
I think that the borrower that you all want in your book wants to be discriminated against positively. They're not being seen. They are begging to be seen. If you get their consent on data that they're able to provide to you, if you're combining it with other kinds of data, conventional and other alternative data, you're in a position to find those invisible primes, as I call it. The privacy concerns on both sides of the border are eliminated with that consent, something we call smart consent, has to be informed and so on. And so, yes, calculate the reason codes, yes, be able to mount adverse action, but also for that consumer, if you've gotten them accurately, you can give them better deal terms, like things in the topic of affordability, what they can tolerate without making them a worse credit risk, or just calculate the whole deal jacket in a way that the consumer it works for them. So what I'm fond of saying, and where both the risk of privacy that you're pointing to, but combined with machine learning comes into play in this room, just using indicative numbers, there may be 7 or 8 types. You could cluster people into 7 or 8 types. So in the FICO world, scores above 700 or above 750, there aren't many types. In the subprime world, what we call the long tail opportunities, you will have many less homogeneous people or clusters. So there'll be, by comparison, 200 or 100 different types. And that's where both the power of the technology, but also consumers opening up, especially the young ones, opening up and saying, I just want to, get a discount on X purchase, or I just want the loan and I'm not getting it. The privacy concerns go away if you're giving them something.
Yeah, so I love the example you just gave where it's discriminatory, but in a positive way, right? So I look at it and go, okay, if I'm applying something from an alternative data perspective, such as bank account level data, they now have in the US, you have opt-in bank account level data and non-opt-in. So whether those give me lift so I can push more people up into a good range with the overall score and take that weighting into account, that's not a bad thing. Now you're consumer friendly versus you're not discriminating against in a negative way, right? Versus you have someone that has a score, say on traditional methods, and they came out to X. Well, in the attributes of using those that bank account level data, it didn't move them up because they didn't meet a certain standard or whatever. They really haven't moved, right? So you're aggregating your models with these different sources and use them in a way that's fine. You need to be careful though from a regulatory standpoint. You may not be able to use some of that data to turn down, for instance, like FCRA compliance stuff in the US, but you might use it in your funding department to go, is this person who they say they are, or is this a real bank account? And there's things like that that can help you moderate that credit risk so you're not right into a early pay default bucket, for example.
I think too, I'll just color that a little bit more. The question maybe comes from a premise in a world where it's you are behind the curtain, especially in direct lenders, and the consumer isn't involved. And we heard yesterday, Vlad and Propel, you can look at the platform, getting closer to that consumer or having more direct relationships is pretty important in a world where the consumers are demanding that. Not just pretty important, it's gonna be, you won't be doing business where that hasn't been considered, or you're treating everyone like, at arm's length and giving them the Heisman. I think that whether it's a platform like Propel or things that have to do with the life cycle of the borrower, collections, making sure that you're integrated with again, a platform or your own platform that's got a seamless set of nudging and behaviors or capabilities and techniques to nudge the behavior that you want. That consumer will be grateful to you. They're not going to be upset. They're going to be thrilled that you're accommodating them in where they live, how they live, which is on the mobile phone, especially for the new to credit and almost all of the new to country. They are way more accustomed than we are in Canada to being living a digital world. They don't even want to talk to going into a bricks and mortar establishment of any kind. And then you have things like the open banking that we've all talked about. My American colleagues may not know, but there's this platform in Canada owned by 3 of the big banks and for profit. It's got 72 or so institutions, financial institutions as customers, SimCore, so they just spun up Core Connect for open banking. We are the first party allowed in to be integrated with that. And you've heard from various panels and both of my colleagues that banking transaction data is super valuable. It's what makes us the 3rd credit bureau in Canada, just on that basis alone. What you can tell in that data is reconstructing, lenders that don't report, reconstructing income that's not being reported to the taxation authorities and so on. There's a long list of different valuable pieces of insights and predictive power you're getting right now. This is not science fiction. This is not something you have to wait even 3 or 4 years for, 5 years. It's right now.
Yeah. So kind of along those lines, right? So as lenders here, banks, you have a lot of data, right? You have your customers' information, all of that. So as a lender, could you use your own data as a source of alternative data if you have their income statements, things like that? Is that something that lenders could do today?
100%. I won't. I'll speak about the American big banks more. That the siloing that happens. Sometimes you don't know your own auto borrower is a customer in your credit cards or somewhere else. So just having, again, I know I overuse the term platform, but having that, make sure you have it internally, and if you don't, get it externally to see those consumers. They're expecting a lot more. We have our legitimate criticisms against big technology, but something that those folks do really, really well in the cloud is know that consumer, know where they are and what they're going to do next, or be in a position to nudge them to make their payments next. That's pretty powerful stuff. And so, yeah, I'll just leave it at that. The data you have already is pretty powerful. You don't have it in terms of the reject inference. If you decline that person and had to go to one of your competitors, then it's counterintuitive. But a clearinghouse or a third party provides that value. You can see where that consumer ended up, anonymized appropriately and so on. But having a third party clearinghouse that sits between all the competitors, as big as Citibank is, they are not the universe. So yes, you can use it. Yes, it's alternative data, but if Mary Smith went elsewhere, it's not really. You don't know anything about her when she shows up to you as a new customer.
Yeah, absolutely. It should be one of your data sources. We again get about 400 lenders that we work with in the U.S. and about 22 billion in the portfolio, and without a doubt, when there is just a perfect example is when there's an existing relationship with that financial institution, we see the default rate is half of what it would be with a new consumer that doesn't have a prior relationship with that institution. So 100%, if you've got your own data, that should be a source or one factor in your decision as to how you're scoring your own consumers.
Yeah, I would add to that. If you look at a typical lender, whatever the numbers are, will differ. But you look at 100 loans, approved 35 to 45, maybe 15 prime, cash 5 to 10 rate. Generally speaking, you're building and customizing models based on that, which you've captured. What about the other 90% you never got? So the more models are great where there's data, right? The more you can enhance those and get a 360-degree view of the universe, like you said, the more predictive you can be. Not in every case. Some data, not all of it's usable, not all of it's powerful. It doesn't need to be weighted overly heavily. So you can have over-reliance, like I talked about earlier. But the more you can have enough data to make those judgments and enhance your models, it's absolutely imperative to do so to stay on the cutting edge.
Well, thank you, gentlemen, for joining, and thank you all for listening. I'm going to open it up now if anyone has any questions for our panelists. We've got some questions. So, Brian and Anthony have microphones.
Yeah, I'm just interested in how you see alternative data helping the saying that Daniel brought up in his presentation, which is about the life cycle events of a consumer that doesn't report on the bureau. So a consumer often goes into a loan believing they're going to pay it. They're obviously excluded from it, okay? But then there's lifestyle trigger events that stop them paying. And I've seen two work very successfully from the UK in the sense that if a consumer moves home, so their address changes, that's a life event. That could be a divorce, it could be a bigger mortgage, which means their payments going up. It could mean they're moving to a nicer area to pay rent. So Santander in the UK will actually not auto-approve anyone that's moved within 12 months because it's a trigger event. Another one that I've seen as well is if someone doesn't file their taxes on time, does that mean they don't have the money to pay what they owe? So with chief risk officers, a bit slower because they're normally, forgive me for saying to people, but they're normally middle-aged grey-haired men that run these departments. They're not so proactively thinking. Where comes to my question, where do you see AI helping the stuff that doesn't report to the bureaus to help us make better decisions?
I'll start with an acronym that I use frequently. I say IAD. It's about the data, it's about the data, it's about the data. You've also heard me overuse the term platform. If you're properly powered with a legitimate 100% AI machine learning based platform, that retraining that I mentioned 20 minutes ago, it gets at the kinds of issues that you're talking about. I can rescore the whole book and re-tier everything every month when the Metro 2s come in, or if I'm integrated with your data as a lender. What I'm doing, unlike what Fitch or Moody's or those guys do, which is roughly, I'm exaggerating to make a point, they're averaging the FICO scores on the application from 18 months ago when there's a securitization going on. I know securitization doesn't necessarily apply to the depository institutions in this room, but that ability to do a reading or take a bead on every single file in your portfolio every month or more frequently if you would like, is part of the answer to your question. Getting at that data is on the consumer in part, but there are also, particularly in the US, not so much here in Canada, a great number of data sources already, and ever more creative coming out. And keep in mind that consumer is actually asking for it. They're actually making this data available. Everybody in this room would probably be stunned, unless you have children, stunned at what the new consumer is willing to give over in order to get a benefit. They're not doing it, they're not going to tell you they changed their address, or they're not going to make you a privy to things if they think you're just if you're just doing it for your own benefit as a lender. But if they see or sense something coming back to them in better terms or a relationship, to your point, then you're in a way stronger position.
Yeah, I would add to your question, your specific example where somebody's moving or they've had an event, they're moving back, and that creates a risk factor, right? So many times traditional methods of weighing these things are very powerful, and then maybe there's some alternative data you can lay in, but that to me is a stability factor. I remember back in the day when I was manually underwriting loans 35 years ago, and it was ability, stability, and credit, like the three-legged stool they used to call it. That's one thing that'll usually show up on an application. Someone's pinging all over or on their credit file because they're bouncing from place to place and they become unstable. The tax return thing, that's, at least in the US, that's not a turn down issue regulatory-wise, but you can use that information maybe, because it's public data, in your process where you're underwriting the loan and going, hey, are there issues here? And it's deeper, do they roll over to the credit bureau or the other alternative data items that I can buy to augment that and enhance my risk models, which is kind of what we're referring to here. And how do you weight those, right? You don't want to overweight yourself or overfit it, and then you're turning customers down that could actually pay you by over-relying on that one data point.
The only thing I would add too, I think it's a valid point. I think, when we look at it, I think the weighting is a good strategy, because if you're a near prime consumer that's moving every 12 months doesn't necessarily scare us as much as a prime consumer that's doing that, because we have the sayings that, the near prime consumers in a constant state of recession. They're more likely to figure out a way to continue to make that car payment for us, and so whereas a prime consumer, I'd be a little bit more weary and maybe weight that differently. Some of that alternative data, if I do see those life event things happen.
And there's things problematically too that may come out in just an old-fashioned credit bureau attribute. If there's stress in that life, you're going to see something roll out of the bureau. So if you're scoring that customer, right, as it referenced in the presentation earlier, they might be a 650, but like Matt said, they're jacking up their debt. You can see they're stressed there. So they're a 650 on the way down, not on the way up. And it's all about identifying those really at the end of the day.
Question out there?
Hi, first, thanks for the great panel, appreciate it, guys. My question is there a risk of overconsumption of alternative data that can potentially lead to decision paralysis? And if so, how do you avoid that, or how do you plan to use it appropriately so it's not, similar to what was just said in the previous question? Just wondering your thoughts on that.
I really think you have to be careful, right? All these things, models are great, but they got to be monitored. I don't care what you're pumping into it. So a lot of that's experience. What's your development team look like? Are they aware of the trends? But also, again, you don't want to overfit things. Hey, pull all this data in, but is it really predictive in the future, or does it make my model worse? So I think having the knowledge around that and the ability to use AI and machine learning to figure those things out is really powerful, but you also have to be careful. Even when you get to a point where you've sold yourself, like, this is great, we're seeing predictive power in these things, even after you develop those and deploy them, you've got to monitor that afterwards, because did the data lie to you somewhere? So then you have to adjust and go back and relook at that and refresh it.
And for us, I mean, that alternative data is only one part of the decision, right? I mean, I think Dan Perry did a good job earlier talking about, that's the yes, no, and then it's, okay, well, what does the rest of the auto loan structure and look like? Because again, if you may look at it and say, hey, this is a 10% probability of default, but I think in Daniel's example, depending on how much money they're putting down in the vehicle that they're purchasing, that cumulative net loss could be much higher based off of the structure. And so these alternative data and the models are great for giving you a first look at the consumer's ability to repay the debt, but then you definitely still have to take into account the actual loan application structure and data that's there to ultimately make a final decision inclusive of how are you going to price it, right? And so that to me this is all great, but you still need to have some underwriting decision and actual intelligence after that to be able to make a good auto loan decision.
On the question as to whether or not alternative data ends up being its own problem or gets in its own way, when you say machine learning is right in the name of the technology. It's learning. It'll shed things that are no longer being helpful, but only if you can do that retraining that I mentioned frequently. And so it's a big infrastructure that comes to bear, but it's absolutely part of what gets considered. It's one of the reasons the technology was developed. Remember what I said, credit is a fluid, kind of like quicksand. It's not a stable concrete pad that remains unchanging, whether that's interest rates and other macro factors, or in the life of a consumer, particularly below super prime and prime. That changing and fluid nature of the beast makes it incumbent on always finding new kinds of alternative data, not just is there so much and it's stagnant or not being helpful anymore. There's new digital stuff coming out every single day, and that's will all of that you won't necessarily have signal in everything that's out there, and that's the point. Learning through that rapidly and continually monitoring it, or having the portal, Propel or other portals as everything on the answer to that question.
We have another question over here. Yes, one over here.
Hi there. So my question on open banking. In Canada, I thought we were waiting for some legislation. Is it fully loaded up? What does the outlook look like for the system?
I'm sorry.
You can't hear me?
No, I couldn't hear. Sorry.
Oh, sorry.
She asked about the
Is that
regulations.
better?
Yeah, you asked about the Canadian regulations for open banking. Ray thought that there was some. It was
Right.
yet to come.
So it's been promulgated. Everybody's expecting. Becomes official, or becomes the law of the land. In who knows? Another panelist earlier put it nicely. Whether that's a year or 3 years from now, but whether or not the regs are making it so the banks and other institutions are moving. They're not waiting for it. And Europe is way further ahead than we are. You have consortia or other standard-setting bodies in the U.S. That are also making headway. And like anything in where digital stuff is involved, it seems to it coalesces eventually. Whether or not the regs are there, the regs will force it and get some consistency into the equation. Everybody's actually, or many people are actually asking for that. Counterintuitive that you're asking for regulations, but as I mentioned earlier, SimCore has not waited. Core Connect is up. It's available to certain parties right now. So it's inevitable. I think the consumer owns their own data, whether we want to believe that or like that or not. That is absolutely the case with the current managing director at the CFPB in the US. It will be the case here shortly as well.
Awesome. Any other questions, or that's it? Well, thank you guys for the great session, and appreciate you guys.